Market fears of a recession have reappeared. Gold's descent was put on hold and at the time of this report trades around the $1985 level. Following the lower than expected preliminary US GDP rate for Q1, market fears of a recession were yet again heightened, and at the time of this report, it appears that the shiny metal is moving in a sideways motion as the markets await the Fed's interest rate decision on Wednesday and the US employment data on Friday. In this report, we aim to shed light on the catalyst driving the precious metals price and assess the future outlook. The mixed economic data stemming from the US has facilitated gold's sideways movement, with the precious remaining on hold near the $1985 level as these words are being written. Last Thursday, the US GDP rate for Q1 came in much lower than expected, with the actual rate coming in at 1.1% in combination with the core PCE rates coming in higher than anticipated on year-on-year basis for March, highlighted the continued deterioration in economic growth in the persisting high inflationary pressures in the US economy, respectively. In addition, the statement by Treasury Secretary Yellen may have provided temporary support for gold, as the ex-date for the US to default on its debt may be as soon as June 1st. The heightened fears of the US defaulting on its debt facilitated inflows towards the precious, given its store of value attribute, and as such may find short-term support until the matter is resolved. Furthermore, the renewed banking fears surrounding the collapse of First Republic reignite fears of banking crisis in the US, which allowed gold to capitalize on a weaker greenback, given its safe haven status in times heightened financial instability. However, we note that the announcement by JP Morgan on Monday that it had purchased First Republic seems to have temporarily alleviated pressure on the banking sector, thus capping the gains made by gold. In addition, the US ISM manufacturing data for April, which was released on Monday, projected a stronger than anticipated manufacturing output by exceeding analyst expectation, thus renewing confidence into the US economy, as the potential for recession was downplayed. Overall, the financial releases from last week facilitated short-term inflows into the precious metal, as market worries of a recession were heightened, yet contradicting financial releases have increased uncertainty in the market, as traders eagerly await the FOMC interest rate decision. The Fed is due to release their interest rate decision on Wednesday, with the Fed's funds futures currently implying a 92% probability that the Fed will raise interest rates by 25 basis points. A validation of the 25 basis point expectation or an unexpected 50 basis point hike could boost inflows towards the greenback and tarnish the pressures to their negative correlation. On the other hand, should the Fed surprise the markets in their off chance that it chose to remain on hold, we may see gold soaring past its previous peak at $2050 and edge closer its all-time highs by capitalizing on a weaker greenback. Although gold traders may be more interested in the forward guidance released by the Fed, in which should a negative economic outlook be presented, it could further fuel fears of a recession, whereas a should positive economic outlook be broadcasted, it could facilitate inflows to a greenback as investor confidence in regain, hence leading to outflows from the pressures. Lastly, looking past the Fed's decision, market participants will shift their attention towards the US employment data on Friday, with heavy emphasis being placed on the US non-farm payrolls figure for April, which is predicted to decrease to levels last seen in February 2021. In the event that the predicted figures will materialize, we may see the greenback further weakening, leading to further inflows into the bullion, whereas the better than predicted figure could strengthen the dollar and thus weaken the pressures. Thank you for watching.